You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. So be sure to check out our live stream via the Mixlr app or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. Learn more about QuickStrike at bantix.com. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. Visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody, that funky tune means it's time once again for TWIFO, This Week in Futures Options, a program where we break down all the stuff hopping and popping over there on the other side of the trading screen. So flipping away from your apples and your spies and getting into some of the commodity options and indeed all equities as well, but on the index side and a lot of other fun stuff, metals, ags. You never know what's going to light it up. Energy, what's going to be on our tape every week. That's why you got to tune in. Every week, my name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting The Options Insider Radio Network, beaming into your ear holes live, this show at least, every Thursday, 1:30 p.m. Central, 2:30 p.m. Eastern. Not that far, not that long after the option blocks. If you join for one, you can listen for the other as well. Of course, get those questions, those comments coming in. We do love to hear from you guys. My usual cohort, my usual partner in crime there, Mr. Sean Smith from FTSE Russell. He's been globe hopping ever since the last time he was in the studio. He went to Florida, I think, for the CME conference. And I think last week in the show, he was in Singapore. This week, I believe he's in Europe. So he's all over the place. I don't envy that man's travel schedule. He'll be back joining us again fairly soon. But not to worry. Got our old friend holding down the CME Group hot seat this week, Mr. ERIK NORLAND over there from the research team. He's the executive director and senior economist over there in CME Group, a.k.a. the guy with all the cool research reports. ERIK, welcome back to the TWIFO program, sir.
Thank you so much for having me back. Glad to be here.
All right, ERIK, we're going to get into all your fun reports, including a metals one that has our audience a little topsy-turvy in a second. But before we do that, let's get into what's going on this week. What's moving and shaking? What are the big movers over there on the CME platform here this week? Let's start. ERIK, I ask all of our guests, I give them all a chance to choose. Should we start with the upside movers or the downside movers first? Where do you want to start, ERIK?
Well, let's start with the upside movers.
This is my barometer. I can always tell if a guest is optimistic or pessimistic by where they like to start. I had a feeling you were going to go upside, so let's go there as well. Top 5 to the big movers this week. Again, you can find all this for yourselves, cmegroup.com/TWIFO. Just go into that market scan section. You'll be able to find this, and then make sure you set the date range for the past week so you can see what's been moving since our last show. Number 5, palladium. Got a bit of a metals theme here to the show this week. Palladium up 3.5%. Been an interesting year for palladium. I think we'll get more into that in a little bit. Number 4, copper. Up nearly 5%, 4.7%. Platinum up over 5%, 5.1% to be precise. Number 2 here, soybean oil up 6.2%. And number 1 with a bullet this week, our old friend iron ore keeps popping up. You guys keep wanting us to talk about it. We try. There's just no real option story there. It's all futures all the time. Iron ore up about 6.8, nearly 7% this week. So a big mover for iron ore. Obviously, a lot of this being driven by interesting demand issues and some supply issues in the case of some of the metals. I think we'll get to that in a little bit as well. On the bottom half, the dark side, number 5 on the dark side, soybean meal off 1%. The good old Ultra Bond off a little over 1%, about 1.2%. Lumber, number 3 there, right in the middle, off 1.3%. Number 2, the Eurodollar, off 3.5%. And number 1 with a bullet this week, nat gas. You know, nat gas is the product that gives and taketh away every week. It's up, it's down, it's up again. Now we're on the downswing yet again here. Some news coming out of Chevron that may be spooking some folks out there, as well as cold now, obviously, but so far the start to the winter hasn't been perhaps as dire as some prognosticated. So maybe that combo 1-2 punch hurting nat gas. Maybe we'll get to that in a little bit. But Eric, we have to start in metals land. You know, I love when you come on because you guys always, you and Blue and the rest of your team there always have great, interesting nuggets of research for us to dissect, and probably some new things we haven't thought about, some new angles to look at products. And you certainly delivered again a few months back with your paper entitled Gold and Silver Options, pointing to a pullback. And I always say you're my go-to guy for all things metals volume, particularly metals skew. That's kind of your darling, your baby. I said years ago, your first time on our network, you came on with your Gold Storm on a Horizon paper talking about the potential for a big move in gold volatility. And I think it literally happened the day or two after that paper came out. So that's still one of the most well-timed research papers we've discussed here on the network. But you made some interesting findings here from this paper that are probably counterintuitive for a lot of our audience. In fact, since we've talked about this paper, a lot of people have written, and we touched about it a couple of times on other subsequent shows, but I've been waiting for you to come on to really sink our teeth into it. I'll just give you a relative sampling of what our listeners have been asking about this. Meltim wanted us to know, do you guys buy that metals only sell off when the calls are bid? That's reflecting this paper. And also, Elian also asked, is there any follow-up data on the CME metal skew study? I find that one somewhat perplexing. Well, you're not alone, Elian, and everyone else who wrote in on this particular paper. But we have the author here right now. So let's start, Eric. Before we get too far ahead of ourselves, why don't you kind of give our listeners a synopsis of what this paper was, what your findings were, and why you think it was so, I don't know if controversial is the right word, maybe surprising to people.
Yeah, well, essentially the paper seeks to examine a pretty basic question, which is the sort of difference between out-of-the-money call option implied volatility and out-of-the-money put option volatility, is that an indicator of trend or an indicator of mean reversion? So in other words, when calls become really expensive, or say out-of-the-money calls become really expensive compared to out-of-the-money puts, is that an indicator that metals prices are going to continue to go higher, or is it an indicator that they're about to correct? And, likewise, when out-of-the-money puts become extremely expensive compared to out-of-the-money calls, is that a sign that the market's going to, have a crash or continue going downward, or is it a sign that it's hitting bottom? And there's a lot of evidence accumulated now over almost a dozen years of history, going back to 2008, that the metals risk reversal, if you will, the difference between the out-of-the-money call and the out-of-the-money put is, in fact, generally speaking, an indicator of mean reversion. And so what we saw over the summer was an example of that. As gold and silver prices took off over the period from May to about early September, those out-of-the-money calls became really, really expensive by historical standards, about as expensive as we've seen them get in many, many years. And as they became very expensive, it essentially gave a signal that that market had become overbought. What we saw subsequently, of course, was a correction in the price of gold and silver, a rather sharp one, actually. It took place kind of in through mid to late September, really going into early November. And now the markets have basically come back to neutral. So if you look at the put call spreads now, they're basically trading pretty close to their average. So drilling down into slightly more detail, the way in which this study works is that it basically looks at the risk reversal, which of course you can get on Quick Strike. You can get daily time series going back to, I think, August 2008. So you have over 11 years of history now. And basically I compare where that series is to sort of a 2-year rolling window. So, for example, if you are at the most positive skew or the most positive risk reversal you've ever been at in that 2-year window, it would get a value of, say, 100. If you were at the most negative skew, meaning that the put option's relatively expensive compared to a call option, that you've ever been in that 2-year moving window, you get a value of 0. If it's exactly at average, you get a value of 50. So it's what we call a diffusion index. So basically ranking it on a scale of 0 to 100. And I compare that rank to how the market actually returns over the subsequent 3-month period, using 3-month options. So, if the market is exceptionally positively skewed, what tends to happen? Well, you tend to see a sell-off in the metals markets. If it's exceptionally negatively skewed, you tend to see actually above average performance. And that's what we've been seeing in gold and silver now for quite some time when they achieve exceptional levels of skewness.
Yeah, and I think the reason why so many people flock to this and were surprised by this is because that's not traditionally the way option skew tends to work. Usually when you see a hefty bid to the calls or to the puts in either direction, usually it's an indicator that the paper flow and everything else is aggregating for a move in that direction. Like 9 times out of 10, that's what you're seeing. So that's what makes this development so unusual. It's also interesting because it's not some esoteric product that no one's ever heard of, where they maybe have a weird or bizarre skew shape. That can maybe be understood. But these are liquid products. This is gold we're talking about here. Product people know they trade fairly frequently is fairly liquid. So it's not a strange, aberrant development in an unknown product. It's a surprising development in a fairly liquid product. In fact, when we first discussed this a few months back on the show, we were hard-pressed to think of other products that exhibited similar developments. I know since you've done this research, Erik, you've sourced out a few. Or are some others you think that you see similar types of, shall we say, contrarian skew setting up out there?
Yeah, so actually the strongest ones, I think, even stronger than gold and silver, are the oil products, by which I mean, of course, ultra-low sulfur diesel, formerly known as heating oil, and gasoline or RBOB. Those are the ones that actually have the strongest sort of negative relationship, if you will, between what option traders think is going to happen in the future and what actually does happen. And WTI kind of follows closely behind that. The relationship with WTI isn't quite as strong as it is with the products, but it's still pretty negative. So when people are pessimistic and they think the market's going to go down, it often winds up rallying. And we got a phenomenal example of that just about 1 year ago today. I don't know if you remember, but in Q4 last year, we had this crash in the energy markets. Huge downdraft in crude oil, ultra-low sulfur diesel, and also gasoline. All those prices fell around 30 to 40% in Q4 last year. And the options got really negatively skewed, and that was a buying opportunity. When they got that extreme negative skewness in December, it was not a signal that they were going to go down further. It was a signal that they had already hit bottom and were about to bounce higher. Then we got a little bit of the opposite of that this spring. After oil prices did in fact bounce higher and kind of peaked out for a while around April, May, they got to a pretty positive skewness and then subsequently sold off. So in certain markets like gold, silver, and then also in some of these energy product markets, the options tend to be, I would I would say akin to sentiment indicators. So, they give you a sense of maybe when markets are overbought or when they're oversold. But I would also warn you, though, it's not a perfect indicator. There's always uncertainty around this. There are times when the market's very pessimistic that something might be going down when it actually does continue to go down. And there are times when the market is very optimistic and it does, in fact, go higher. But sort of the general tendency for gold, silver, and for the energy markets, you do tend to see that sort of negative relationship.
Well, let's see what's lighting it up out there in the gold markets right now. Since we're talking all things metals, again, you guys can follow along, cmegroup.com/TWIFO. Pull that drop down there to the metals and then to gold. You'll see we're at about a 1472, almost 1473 coming into showtime. Puts us up about 0.5% here on the week. Again, trying to break through that 1500 level. That everyone likes those nice even levels in the metals in particular. And 1500 is the next one. So no surprise then that the lion's share of the paper this week, at least 30% of the overall flow coming in Jan, with the lion's share of that coming in the 1,500 calls. In fact, pick a month. It seems like 1,500 calls were where the action was across the board, but the big trade of the week was the 1,500 calls in January, doing nearly 7,000 contracts here this week. The lion's share actually coming today. So on the heels, of course, of some of the Fed developments as well as this trade war deal, we're seeing almost half of that paper, actually a little more than half of that paper, going up today. So interesting developments out there. Volatility also ticking up a wee bit here this week. Up not a ton, about 0.1% to 0.5%. You get a little bit farther out into the year next year. So vol a little bit up. Let's look at the skew here as well, because we are talking metals skew here right now. We'll go out to that Jan contract, which has exactly 14 days to go. That's right at the tail end of my barometer. I usually like to cut it off beyond 14 weeks. It gets into all sorts of gamma, and the skew gets a little bit crazy, but we'll keep it because it's at that 14 level right now. So we'll look at it one more time here on the show, and that's also where the aggregate of the paper was here this week. The puts in that Jan contract were 1.1% cheap to the at the money this week. Getting a little bit cheaper, 2.1%, so coming in about a point there. And then the calls were rich last week, 5.3%. This week they've come in as well, about 3.6% rich to the at the money. So calls still bid, but a little bit less, and puts getting a little bit cheaper there on the week. Let's also talk some more metals before we roll out of the metals here, Eric. I mentioned palladium here at the top of the show. Palladium's had a crazy year. It's up 60%. Year to date, notwithstanding this week's just big rally. A lot of people debating what's driving that out there. Some people saying there's been some power outages there in South Africa. That's made it hard to mine it, so that's been an issue. Others saying it's just the old supply and demand writ large here. Going demand and not enough supply to meet it. It's pretty much Econ 101, and that's what's driving it. The old more buyers than sellers routine. Either way, palladium moving quite a bit. Also, speaking of supply issues, Eric, I know you've been a busy beaver here. Just this past week, cranking out a bunch of research papers, including this one from yesterday about industrial metals. Not a topic we get to often on the show. Not the sexiest area of the metals, but it trades. It's interesting and certainly worth noting. Your paper entitled "Can Demand Meet Supply Challenges?" So, Eric, this is kind of what I was just touching on. Some of the supply issues here on the metals side of the fence, particularly on the industrial side. Did you find any interesting nuggets you can relate to our listeners here, Eric, from your most recent paper?
Yeah, so, just going back for a moment to platinum and palladium, they make such an interesting contrast with with what I would call the other industrial metals. Now, of course, you may correct me and say, wait a minute, platinum and palladium are precious metals, right? And the thing is, they are precious metals only in the sense that they're very, very expensive. And the reason why I think they're really industrial metals is that the main application of platinum and palladium is really in the automotive industry. That's actually, it's mainly being used for catalytic converters. So something like 2/3 of the use has to deal with autos. And there's a really interesting contrast between platinum and palladium and the other sort of base or ferrous metals, like copper and aluminum and iron ore, et cetera. And that distinction is that platinum and palladium supplies are just not growing. There are really only two countries that supply platinum and palladium, and those countries are South Africa and Russia. Together, they have something like 90% of the market. And the supplies of these metals are really small. So to give you an example, this year the world will mine something about something close to 100 million troy ounces of gold. The mining supply of platinum and palladium is more like 6 to 8 million ounces per year. So in other words, about 6 to 8% of what we do for gold, and it hasn't grown in over a decade. It kind of peaked out in terms of supply around 2005, 2006. Part of the reason why palladium's doing so well has to deal with that diesel scandal that we had earlier this decade, where a couple of big automakers were found to be sort of falsifying results about diesel engines, and so platinum is used as a catalytic converter for diesel engines. It helps to get rid of things like nitrous oxide emissions, etc. Whereas palladium is used in gasoline, so it was essentially plus for gasoline, negative for diesel, was good for palladium, bad for platinum. And what's made palladium so tight is that there's just no supply growth, and the supply is dominated by only 2 countries, so extremely concentrated. You contrast that with, say, copper. Copper supplies since 1994 have grown by about 125%. We're producing 2.25 times as much copper now as we did back then, 2.5 times as much steel. We're producing over 3 times as much as aluminum, and 3.5 times as much iron ore. And so we've had this massive growth of all of the base and ferrous metals. Their supplies are just burgeoning, and a lot of that has to do with this massive run-up in price that occurred between 2002 and 2007. When the price of aluminum doubled, the price of copper went up about 450%. The price of iron ore soared. The price of steel soared. So it just incentivized this huge amount of investment. So we've seen that investment come online during the last decade. And so now we have essentially flipped the economic problem. 2 decades ago, the problem was there was way too much demand chasing not enough supply. Sort of like what you see in palladium today. And now the problem for these base and ferrous metals, including copper maybe most importantly, is that you have way too much supply, and all of this is chasing a lot sort of inadequate demand. And the real linchpin of these markets is China. China buys about 40 to 50% of the world's steel, copper, aluminum, and most of the other industrial metals. And about 2/3 of the world's iron ore goes through China. So it's really incumbent on these metals that China's growth continues at a very strong pace. If it does not, the risk is very, very much to the downside. So any signs of slowing in China can be really bad news for these various metals. And I would add, that for platinum and palladium, sort of as a group, even though those 2 metals have diverged vastly in price, automotive demand is really the key to their future.
You hit on a wide array of metals here. Let's see if we can run down a few of them. Some of them not really big options trade, like palladium. Obviously, been moving quite a bit. Not really an options tail to be told there. It did a whopping 78 contracts this week, so not really a big options story. Let's move on to some of the more, let's go in order of volume, some of the other metals. We don't get a chance to sink our teeth into that often. Like you said, they're kind of usually mentioned as precious, but platinum and palladium both have industrial uses as well. Platinum, a little bit more active from an overall options perspective, doing about 1,200 contracts out there this week, which is a little bit more. The lion's share of that, the big print 400 of them of the April 980s here this week. So out of the money calls there in April. The big play out there, quote unquote big, not Eurodollars big, for platinum, pretty big. And copper is probably one of the more active of the non-precious metals out there, doing about 14,000 contracts, 14,000, almost 14,500 this week. The lion's share. Well, before we even get to that, let's see, platinum at about a 280 or so out here coming into showtime, so that puts it up. I said right now it's up about 3%, so still maintaining a lot of that upside here this week. Vol also up pretty strong, up over a point in most of these contracts, 1.25 to 1.7 or so in some of these contracts. And of course, that front contract has about 2 weeks to go is up nearly 3 points. Not a lot of vol left in that contract, though. But still, interesting developments out here. The big print out here, we're about 280, a little north of 280 right now in copper. The big print, it actually is a 270 puts, going up about 1,200, almost 1,300 times That was pretty interesting, pretty steadily throughout the week, followed hot on its heels by the 279 calls. So interesting strikes they got going on out here in copper with nearly 1,100 of those as well. Almost all of that coming on Monday, about 1,000 going up on Monday. So an opening on both of those, bias towards the opening on both. So interesting, kind of a tight little strangle, a risk reversal out here in copper, depending on how you want to look at it. 270 on the downside, 279 there on the upside. So there you go, a little bit of a non-precious metals overview for you as well. We've got to keep on rolling. The other products talk about. Erik's been very busy and other products as well. He doesn't just talk about metals skew, even though he talks about it a lot, and we love to sink our teeth into it here on the program. Erik, you've been busy also releasing papers this past week or two here on all things yield curve, kind of debating, I guess, the various, which yield curve is the right one. Of course, everyone since the first inversion has been obsessed with yield curve. You had a paper come out on the 3rd talking about which yield curve foretells the best growth, and you followed it up. Not to be outdone, that wasn't enough yield curve papers for you in 1 week. You had to follow it up 6 days later with more research about the yield curves, this time breaking down what global yield curves are signaling about 2020 growth. So break these both down for our listeners here, Erik, because you've been debating yield curves for the past week. What have some of your interesting takeaways on the yield curve front, sir?
Yeah, so, I think that, just first of all, with respect to options, I think that yield curves have an incredibly strong relationship with options markets, which is to say, when the yield curve is very steep, exceptionally steep, like it was for much of the earlier part of this decade, it tends to repress volatility. It tends to bring volatility levels down. And I think the reason for that is very simple. When central bank policy is easy, the yield curve is steep. And when central bank policy is easy, a lot of money goes into the markets. Buyers and sellers find one another very, very easily. And when they find one another very easily, somebody can execute a gigantic order, and there's somebody there to take the other side of that trade. And so prices don't have to move very far, so realized volatility falls. And, of course, if realized volatility falls, eventually implied volatility has to go down with it. By contrast, when yield curves get really flat, you wind up seeing usually an expansion of volatility. Central banks take money out of the market. Eventually somebody tries to execute a big trade, and suddenly there's nobody there to take the other side of that trade, so prices start moving, realized volatility rises, and of course implied volatility has to rise along with it. And so I think that the shape of the yield curve should be of tremendous concern to A, economic forecasters, which is kind of more the point of these recent articles, but B, also options traders. And so the question is, which yield curve do you look at? So you mentioned we had a yield curve inversion earlier this year. When people say there was one earlier this year and now it's flipped back positive, what they are referring to is the public sector yield curve. So essentially the difference between, say, 30-year bonds and T-bills, or maybe 10-year bonds and T-bills, or maybe 2-year and 10-year treasuries, things like that. And so, that's nice. That's fine. You can look at the public sector curve if you want. But the problem with this is that there's only one entity that borrows at the public sector rates, and that's the U.S. government. And the U.S. government, the problem in the U.S. economy has never been that the government's having trouble borrowing money. That's not what the problem is. The U.S. economy and markets get into trouble when the private sector has trouble borrowing money. And we also have a private sector yield curve, too. And so that's really the difference between, say, 3-month LIBOR and, say, 10-year or 30-year swap rates. And what I think is of particular concern with respect to this other yield curve, the private sector yield curve, is that it is still inverted. 3-month LIBOR is still higher than 10-year swaps. So 10-year swaps are trading below 10-year treasuries, which is weird. It has a lot to do with massive government debt issuance. Budget deficits are now almost 5% of GDP, 2.5 times what it was 3 years ago. And at the short end of the curve, you also have a lot of stress. So, LIBOR rates are actually way above T-bill rates. You have a lot of stress in that short-term funding mechanism that we saw kind of explode in September. We had all these problems in the repo market. So you still have an inverted yield curve on 3 months to 10-year and extremely flat on 3 months to 30-year using LIBOR versus, say, 10-year or 30-year swaps. And so what I think that indicates, and so basically the point of this paper real quick was that the private sector yield curve actually does a much better job of forecasting future GDP growth. So all of these articles saying, oh, the yield curve's come back positive, don't worry, the economy's fine, don't believe that. That may not necessarily be true. The president's been very critical of the Federal Reserve for having rates way too high. From this perspective, there may be something to that. There may be, something to the Fed still having rates considerably too high. So, yesterday when the Fed said that, that basically they're planning to keep rates on hold for a year because they're done easing. They're good now. They cut 75 basis points. In the view of the private sector yield curve, they actually have monetary policy really, really tight. And I think that's a concern because we have basically no inflationary pressure. So if there's no inflation to kill, why have tight monetary policy? And then secondly, I think that they may wind up provoking an expansion of volatility in the markets. And I think we've already been seeing that over the last few years. And we haven't seen volatility go dramatically higher. But when you look at something like the S&P 500 options, or even more recently options on gold, silver, on treasuries, they're starting to trend higher. We're starting to see this pattern of higher lows and higher highs. And so I'm really concerned that they have monetary policy way too tight. With respect to this other paper I wrote, it looks at the same phenomenon, but instead of just looking at the United States, it looks at 23 other countries, or I say 22 other countries, so a total of 23 countries. These 23 countries, and I should say one currency area, of course, the euro, which is 27 countries by itself, so it's really 50 countries. These 23 different yield curves, every single one of them has a positive correlation to growth between 6 months and 15 months forward. And so if you think that there might just be a sort of a random relationship between yield curves and future growth, in that case, you would say that each yield curve should have a 50-50 chance of having a positive correlation with future growth. The fact that all 23 of them have a positive correlation and none of them have a negative correlation, the chance of that happening just randomly is essentially 1 divided by 23rd, 1 divided by 2 to the 23rd power. So it's about 1 over 8.3 million. So the yield curve is a powerful indicator, not just in the U.S., but worldwide. When you look worldwide, I'd say in about 3/4 of the world economy, you're seeing yield curves that are exceptionally flat. So it's not just the U.S., it's also the Euro area, it's also Mexico, it's also other European countries that are not in the Euro, such as Switzerland, Sweden, Norway, the United Kingdom, our neighbors, Canada, Japan, Australia, a lot of different countries, including some smaller ones, like Thailand and Israel and a few others, are basically showing really flat yield curves as well. So it's not just the Federal Reserve that seems to have central bank policy maybe a little tighter than it needs to be. It's a whole bunch of other central banks. And you may see that, say, okay, that's really weird. How could the ECB, which has negative interest rates, or Sweden, which has negative interest rates, how could they have policy too tight? And the answer, I think, is that negative interest rates are not working. They're actually taxing the banking system. They're actually slowing the economy, and they're actually really damaging the European banking system. So you open up the newspaper, and every day there's a new article about a German, French, or Italian bank that is closing down trading operations, removing traders, pulling out of this market, pulling out of that market. And all of this implies a reduction of the provision of liquidity to markets. And I think all of that is going to translate, A, into slower economic growth, but B, also into more volatile markets. So, the 2010s were characterized by low volatility. I think the 2020s will be characterized by a shift towards much, much higher volatility.
I like that. Interesting. And you haven't heard a lot of economists, ERIK, lamenting that rates are too high and monetary policy is too tight. Usually lately it seems like it's the opposite. They're all lamenting the fact that the Fed has cut too much and they won't have enough bullets in the chamber should the economy turn, should a recession hit, for them to do the inevitable rate cuts that they'll need to do. It sounds like you take the opposite end of that debate, Eric. You think they're still too high?
I think that they're far, far too high. I would say that the Fed, if I had to guess, I'd say they're probably about 75, maybe 100 basis points too high. And I think that this whole idea that, well, the Fed needs to raise rates so they'll have bullets in order to prevent a recession, or when a recession happens, that they can then lower rate. This is honestly the most counterintuitive or most factually incorrect argument I've ever heard. Basically, it's sort of like saying, well, we need to light our house on fire so that we can then put it out later on by dousing it with water. It just makes no sense. I mean, by raising rates too much, they're going to bring on the recession or potentially a downturn, or at least increase the probability of a downturn that would otherwise be completely preventable. So, I think that they're taking a lot of risks by having raised rates so much. And if you look around the world, the Federal Reserve was really the only central bank that raised rates in this manner. They raised rates 9 times. Now they've cut them 3 times. So they still have 6 rate hikes embedded in there. The only other one that's really done that are our next-door neighbors, Canada and Mexico. Canada raised rates, and Mexico raised rates a bunch of times. Mexico, by the way, is actually in a recession right now. They have been in a technical recession now for the last, say, 6 months or so. And you look at the other central banks around the world, nobody else, People's Bank of China, Reserve Bank of Australia, Bank of Japan, everybody else has been trying to keep monetary policy easy. The Federal Reserve is the only one that's been kind of out there by itself raising rates. And I think they took a lot of risk doing that. And I think that we haven't really seen the results, because when a central bank moves policy, kind of on average, it takes about 15 months to see the fruits of that. And so I still think we haven't really seen the consequences of the tightening cycle yet. We're starting to see it a little bit. Growth has come down from 3% to 2%. But if I had to guess, it's going to come down further, maybe down towards 1% growth next year.
Right. There is that interesting logical fallacy out there, people who are hand-wringing over not having enough bullets to the downside. But you're right. If the rates are too high, they could end up bringing about the very thing that they're concerned about, which is the economy slowing down and turning to a recession, perhaps earlier than it would have otherwise, or maybe before it would have otherwise turned. So you're right. A bit of a catch-22 there for the economists. That's why they call it the dismal science, right? You can often get caught in these types of traps. For all of you out there who've been hand-wringing as well, including, I'm looking at you, Russell, out there's been on the show many times, saying we don't talk enough rates here on the show. That's a good segue into getting some rate series. Just talking yield curve in 10 years. We talk Eurodollars a lot. Let's talk a little bit of the 10-year. Doesn't get on the show here too often. 10-year at about 128.11 out there right now for all of you who don't play along in this market all too often. A fairly active one, as you might expect. We're just talking about 14,000 contracts being pretty active in copper. The 10-year, about 2.7 million this week. So a little bit of a different beast out here on the rates side of the fence. Vol, kind of a mixed bag once you get beyond that front contract that has exactly a day to go. The vol is pretty much coming off not too hard, a little bit out here. It's not a big vol apocalypse out here. The most active contract was the Jan monthly by far, almost half, about 43% of the paper going up out here. And I said we're at about a 128.11 or so. It was the 130 calls that were number one with a bullet out here this week, doing 169,000 contracts. That's a fairly active contract. And it was not just in Jan where the 130s were active. Also out to Feb, 130s doing 104,000 out there as well. So that's a pretty active contract across the board. And we look at the back to Jan here. Actually, they're pretty active all week. The most active day was Tuesday, 55,000. But actually, I take it back. Monday did 56,300. So, and pretty much opening throughout the week. So a lot of opening paper on that near-term upside strike out here. Let's look at the skew really quickly before we roll out of rates. We got to get some other products here as well. The puts here were about 2.5% cheap to the at-the-money in Jan. This week, they're 1.1% cheap. I should say they get bid up. They've gotten bid up here a little bit. They're not quite as cheap as they were. The calls were nearly 5% rich. They got the money. They're now 1.2% rich. So the calls have come in. The puts getting a little bit of a bid out here in the 10-year, but we have to keep rolling. Eric was just talking about skew in WTI and crude, so we can't leave without talking a little bit of energy here as well. Erik, this has been a popular topic for you out here as well. You and your cohort there, Blue, as well, both been diving into the crude front. Blue had a paper not too long ago about how the Saudi Aramco IPO may fundamentally change the dynamics of the crude market going forward. Maybe the Saudis shifting some of their focus away from being the, shall we say, the puppet masters of global crude supply into more managing their positions in the Saudi Aramco shares as a result. And also, you had a paper not too long ago as well, getting back to your old favorite skew. That's why I say you're my go-to guy for skew research, talking about oil options skew strikes again. This came out in October. This was exactly 1 month after the big attacks, the drone attacks in Saudi Arabia, which I and many of our guests on this network kind of were surprised at just how much the market effectively shrugged that attack off. And your paper kind of broke that down as well. 1 month later, skew had mostly returned to normal. You have a couple of caveats in there as well, which I'll let you point out in a second. But maybe let's start there. We haven't had you on since those attacks. Were you as surprised as I and all the rest of it seemed like the market was that effectively we had about 1 day, not even, maybe I think a few hours of trading after that weekend where the calls were extremely bid, and that was about it. The calls came in almost immediately after that and never really reached that level again. Were you as surprised as I and many others were that it wasn't a more pronounced impact in the marketplace? And then also break down what else you found in your paper, obviously, here, because a lot of people like crude skew. And then also, are you buying what Blue is selling on the Saudi Aramco IPO front and how it's going to impact the crude market going forward, sir? A lot to unpack there.
Yeah, a lot to unpack. So, let's start with what happened on September 14th. It was just honestly got to be the weirdest story I have heard all year. Now, I've maybe heard weirder stories in the past, some of which come out of Saudi Arabia, like the Jamal Khashoggi killing, but this was a very, very strange story. So basically on September 8th, the oil minister basically gets fired and replaced with a member of the royal family. And then 6 days later, there's this attack by drones on Saudi infrastructure that apparently knocks out half of the kingdom's production. So that takes 6 million barrels of oil per day, 6% of the world total oil off the market. And so, markets open up Sunday night. I see them up like maybe 11 to 14% or so. And it seems like a big one-day move normally, but actually a really small response given the seeming magnitude of what had happened. And these photos coming out showing oil refineries or oil production equipment burning. But then they come out and say, oh, it's all going to be repaired in 2 weeks. And the market seems to accept that. And everything just goes back to normal. It's a very strange story. I honestly still, even with 3 months perspective, don't know what to make of that whole story. It's just very, very odd. But that said, the oil options markets did give a pretty strong contrary indication. The oil skew normally is negative, which I think is surprising to people who are not practitioners of the oil market. I think just a layperson might think that normally oil options should skew upward because the 1973 oil crisis, the 79 oil crisis, Saddam's invasion of Kuwait, the U.S. invasion of Iraq in 2003, the Arab Spring, etc. The real risk in oil is that you're going to have this massive upward spike in prices. That is not generally how the options market see it. Usually the option market skews negative. We did get the skews flipping positive for a few days there, actually a few weeks even. But then they gave their usual signal. They said this rally in oil that happened in the aftermath of this apparent attack is not going to last, and indeed it did not last. The oil options market, when it gets really positively skewed, often signals a coming sell-off, and we indeed had that sell-off hit the market in late September and early October. And since then, we've kind of had oil options come back, I would say, pretty close to neutral. They're not really giving a strong signal as to where the market's going right now. So with respect to the Aramco IPO, it did actually happen. It's gotten off to apparently quite a good start, in terms of the equity price going upward. I think that this gives sort of, Saudi the Saudis maybe a sense that they can maybe hedge their exposure to oil in a different way by buying or selling the equity of Aramco. And so it may indeed wind up changing their behavior with respect to the markets. But I still think the single biggest story in oil is the soaring U.S. production. You have just massive growth in production that came out of the Permian Basin in particular. And what's really amazing in the U.S. is how low the oil rig count is. Oil rig counts have fallen a lot. Production continues to increase because productivity continues to rise. And I think if we ever were to see a real crisis in the Middle East, that pushes prices up to, say, $70, $90, $100 per barrel, what's happened in the Permian in terms of production could also happen in Eagle Ford and Bakken and other U.S. regions. And the U.S. has the potential, if oil prices were to go back to, say, $100 per barrel, to increase its oil production by maybe 4-6 million barrels per day, an additional. In addition to that, there will apparently now be drilling in the Arctic National Wildlife Refuge. By 2030, that will add an additional 1 million to 1.5 million barrels per day. So the U.S., I think, really remains the swing supplier here. OPEC, I think, is not looking so strong, and I think the Aramco IPO maybe weakens OPEC a little bit further. And all of that, I think, will cause oil options to probably continue to skew downward on average over the next decade.
Speaking of the skew, that's probably been one of the most frequent questions we've received on the show here is, what will it take to really budge the crude skew to the upside? The call skew can't really seem to catch a bid and maintain it. We all thought, sounds like you did as well, that massive attack, I agree with you, it is one of the stranger things we've seen, a huge amount of global crude production taken off the map at the drop of a hat, and the market effectively shrugs. Everyone thought that was going to be the moment, the inflection point where the calls would effectively catch a bid, and they did ever so subtly for a little while. And then we've had guests come on since then, break it down how it lasted not even a full trading session. It was a span of hours that call skew was starting to come in already. And it is very surprising. I agree with you, very strange the way the market reacted to that and effectively bought the Saudi suggestion they were going to have it all fixed in no time. It was a mere blip, even though it was an enormous amount of damage. You're right, from looking at all the various photos out there. So it has been a constant refrain from our audience. What's it going to take to really cause crude to catch a bid? We've had traders and market makers from that market come on and talk about the lack of any sort of sustained interest and upside here. Let's see if this week is the week, but it doesn't seem like it is. Crude coming in, like we said, WTI at still north of the 59 handle, 59 and about a third or so, up about 0.2%. Not a big week for crude. Kind of unched from an underlying movement perspective. Vol also coming off a little bit here, but not a ton. It kind of depends where you're looking. Once you get out to Jan or into February, off about a point, so a little more out there in the nearer portion of the curve, not as much. The most active contract out here this week was the Jan contract that's going out in 4 days, doing 41%. This kind of puts to the lie to everyone out there who says, oh, no one wants to trade weeklies in crude. They clearly do. They're trading a contract that has 4 days to go. It's just not listed as a weekly. So that's something we've talked about before, how something is there. The devil is in the details, why folks aren't pulling the triggers on the weeklies, but they will trade a monthly when it gets down to less than a week, with nearly 41, almost 42% of the paper going up out there this week. The big trade was the Jan 60 calls up to about 16,400. So not surprisingly, near-term paper, near-term upside as well, as we're threatening that 60 handle. Not surprising that would be number one. Obviously, it's hard to parse skew when you're talking 4 days to go. So let's go out to the number 2 month and see if we can intuit what's going on out there. That was out there in the Feb contract, doing 17% of the paper this week. And the puts were bid last week. They were 10.2% rich this week. They've 9.3%, so come in a little bit. The calls were, as we said before, can't get much love. They were 7.2% cheap. At the money this week, they're even cheaper. Nearly 9% this week. Of course, we had the OPEC over the course of the past week as well, so some event risk coming off the table out there as well. All right, we a lot more papers to talk about here, but I want to make sure we get some of you guys here on the program as well. So without further ado, let's keep on rolling into your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, let's see how many of you we could squeeze here onto the final few minutes of the show. Someone, I don't know the name of it, who shared this comment. There's a comment from Darren Fessler on Twitter about the corn markets. He said, the fund's playbooks for corn are as follows. Monday, sell. Tuesday, sell. Wednesday, sell. Thursday, sell. Friday, sell. Saturday, imagining to sell. Sunday, imagining to sell. And then opening sell orders. So clearly he's at least thinking the funds are fading corn. We're seeing like corn actually kind of unched to slightly up here this week. We didn't get a chance, obviously, to break down corn. You can really quickly. We see corn at about 377. We're seeing the 380 calls out here in Jan doing the lion's share of the paper with 18,500 lighting up the tape. The vol, again, kind of a mixed bag, slightly unched to creeping up as you get a little bit farther out there. And the skew, really quickly, the puts were about 5% cheap this week. They're 2% cheap, so the puts getting a little bit of a lift. Calls 7.3% rich this week. Calls annihilated. Calls are almost unched to the at the money. So the call wing has come in quite a bit. That's interesting in and of itself. So the underlying movement, not so much, but the skew changing markedly out there. There you go. All you corn heads who write in. Eric, that's the challenge of doing this show. Everyone wants every product on here all the time. You can't squeeze them all into an hour. Speaking of squeezing things in, Eric, you're just talking about yield curves. You said you were concerned about the levels of monetary policy. Looks like someone listening live, almost a noob is their handle, chiming in. They responded with looks like they photoshopped the cover of the Time magazine. They said person of the year is, they put Jerome Powell in there instead of, I believe it was that Greta girl for the climate. They put him in there. So apparently, Eric, maybe, I guess they're taking a contrary opinion to yours. They like what Powell and the Fed have been doing there, Eric.
Well, I mean, I think that they definitely did the right thing to cut interest rates these last three times, and I'm not sure that they really ever should have raised them up to 2 3/8. Yeah, raising them to 2 3/8% the end of last year, I think was taking a big risk, and I think that we haven't really fully seen the results of that yet. It takes say anywhere from 6 months to 2 years to see the impact of either rate increases or rate cuts on economic activity. And I think that we're going to see the impact of their 2015 to 2018 rate hike cycle, especially the steep part of it, in 2017 and 2018. I think we're going to see the results of it in 2020. And I think it's going to probably translate into slower economic growth. And, you can always make an argument in favor of slow growth. If you have excessively high rates of inflation, the labor market is just, generating wages that are going up way faster than productivity. None of that's happening now. We have inflation at 2%, earnings growing at 3%, productivity at 1%. That's all suggestive of very stable inflation. So I just don't see why it was necessary to tighten so much and take the risk of slowing down the economy so much. When they say that they're on hold, I don't know that I believe them. I think they might go either way depending on what happens. But I wouldn't be surprised if they wind up cutting interest rates further sometime between now and say 2022.
Listener, sounds like Eric's not agreeing with your Jerome Powell Photoshop Person of the Year on the cover of Time. Direct your comments to Eric there. All right, let's keep on rolling. Speaking of comments, Billet writing in, long time, first time. Well, welcome. We love all you folks out there, first-time writers and long-time listeners. We love all of you. He goes on to write, I like the frequent check-ins with the research folks over there at CME. Well, there you go, Eric. Getting some love here from the listeners. He says they put out a lot of interesting content. Also enjoy the episodes with the market makers and traders to get the views from the trenches. Great content Thank you very much. Well, thank you. Thank you, Mr. or Mrs. Billet. We love all of you out there. All the love you guys send us is returned back to you guys in spades. After all, you guys are the reason that we do this and every program here on the network. So glad that you guys are enjoying it. There you go, Eric. Good timing for you. You got getting a little bit of love from the listeners. What do you think, sir?
Oh, well, thank you so much. I'm tremendously appreciative. And you're right. We write all of our articles for a broad audience, and so we're very, very pleased if people find them to be useful or insightful.
Yeah, you guys can see, obviously, the sheer volume of the output that Eric and Balud have. They come on roughly once a quarter or so, and we have far too many papers to get to that they've done since the last time they were on. So keep up with them, AssimiGroup.com. They're not hard to find. They usually feature your work, Eric, yours and Balud's, right on the homepage there. So click on the articles, and you'll see a whole list of various articles and research papers that will definitely, if I can promise you nothing else, they will keep you busy for some time to come. All right, we'll close out with this one. This comes from DM75. He or she wants to know, what are you expecting when Bitcoin options launch on CME next year? Oh, and happy holidays to the Options Insider Radio crew. You guys are the best. Well, thank you. Once again, right back at you. We love you guys. No, you guys are the best. The listeners, you guys are the best out there. But we appreciate all of your well wishes out there. The Bitcoin options. This is an interesting one. I encourage you, DM75, check out our crypto rundown program. We do a lot of breakdowns of what we're seeing out there. I would have to imagine, absent of any other evidence to the contrary, that what we're going to see when the options finally launch on the Bitcoin futures in January. So that's only a couple of weeks away, which is crazy. I've been asking for how long now to get the options on those futures. Finally, 2+ years later, we're going to see them, which is fun. I would imagine vol-wise, skew-wise, it's going to shape up a lot like what we've been seeing out there on some of the other venues that have been trading options for a while, like Deribit and the others. Again, we break a lot of that down on that crypto rundown show, so I think we're going to see probably implied vols, probably at similar levels, skews probably at similar levels. Hopefully, one of the things we've been lamenting about those platforms is there hasn't been a ton of options volume on those contracts. So hopefully CME bringing options on their listed future, which has been doing pretty well of late, hopefully that will open the door to some new players, because we're having a hard time parsing any interesting sizable flow on those venues. So hopefully CME obviously has a pretty broad reach. Get some more people out there trading the options on those. We can really start parsing and seeing what's going on out there. But I expect all things considered to be relatively similar, at least in the initial onset, to what we're seeing out there on some of the other platforms that have been trading options for a while. Eric, we didn't get a chance to really talk crypto. Is this a product category you've been maybe watching with more interest leading into the launch of the options? I know you're a skew guy. You got any interesting maybe crypto research up your sleeve, sir?
Yeah, I haven't published on it in a little while. The last article that we published on it, I think, was in March of last year, so it was about 21 months ago already. It seems like it's gone really, really fast. That article, I think, though, is still pretty relevant. When it comes to the options, I guess the first thing I would expect would be incredibly high implied volatility. If I remember correctly, the last time I looked at it, Bitcoin's realized volatility on a 12-month rolling basis was something like 70 or 80%. So I think it's going to have a really high implied volatility. In terms of which way it skews, though, I am totally agnostic, and I'm just as fascinated as you are to see, if we can, get some sort of meaningful skewness data out of it when it begins trading. I don't really know, but I think that if you are interested in crypto, we bring this up in the paper we wrote, a year and a half ago or almost 2 years ago. And that's it. If you're interested in where crypto prices are going, in particular Bitcoin, there is a website out there called Blockchain Info. And it has just phenomenal data on sort of the internal economics and workings of Bitcoin. And there's really one indicator in particular that I think has been really good in the past for signaling where Bitcoin is going, and that is the cost per transaction. So essentially when cost per transaction is low, Bitcoin often winds up getting a bid and starts heading higher in price. When there are spikes in transaction costs, Bitcoin prices often crash. So 2 years ago when Bitcoin peaked in December of 2017, there had been a huge spike in transaction costs before that. And lo and behold, we had another crash in Bitcoin. It was the third major crash. The two previous ones, the ones back in, trying to think exactly when they were, probably about 2010 and 2013, had also been preceded by big spikes in trading costs. So Bitcoin, started to recover earlier this year. It was going up, got to around maybe 14,000. We had another spike in trading costs, and that also, sent the price of Bitcoin much lower. And so when I'm talking about trading costs, I'm talking about the actual, I hesitate to say physical Bitcoin trading into various crypto exchanges. And so that, I think, is a really good indicator. It may also potentially be a good indicator of skewness. Obviously, we don't know that that's the case since the options haven't launched yet. And indeed, it will probably take maybe a few years before we really assemble enough data to know whether that's the case or not. But definitely something to keep an eye on. Second, slightly less good indicator is trading volumes on the actual, sort of physical, if you will, crypto exchanges themselves. When volumes are rising, often you see a rise in Bitcoin prices that follows that. When volumes stagnate or fall, often that's followed by a decline. So that's something that may also inform options traders as they sort of develop prices and engage in price discovery around Bitcoin.
All right. Unfortunately, that music means we've come to the end of another epic journey through the world of futures options. Before we go, I want to, of course, thank my guest here, Mr. ERIK NORLAND, for joining me. ERIK, always fun to have you on so we can catch up on the latest. Like I said, you guys are busy. You're cranking out you do this just this past week alone. So, ERIK, maybe before we go, if we just talk crypto, if you want to leave our audience with any other hints, any other teases for what you or the team are working on over there, now is the time, sir. The floor is yours.
Oh yeah, so we have a couple new papers coming out. So one of them is going to look at the equity market. Of course, maybe the subject of the most intense and long-term interest in terms of options. The ones where we have the longest price histories. Basically, the equity market, we think in many ways doesn't resemble at all where we were 10 years ago, but in some ways looks a lot like the late 1990s. Very concentrated rally, a lot of focus on technology stocks, et cetera. And not very much like it did 10 years ago, but a lot like it did in the late 1990s. So that's coming up. We also have a paper coming out on the Canadian dollar and the U.S. dollar and how Chinese growth is actually the main driver of the exchange rate. We call it the loony paradox, that the main player in the U.S.-Canada exchange rate is not the U.S. or Canada, it's actually China. That might be interesting for anybody trading that one. And also there's a lot of sort of corollaries between that and the Australian dollar exchange rate. So some FX stuff coming up. And then lastly, we have the British elections happening tonight. And if you're looking at British pound options, very, very skewed to the downside at the moment ahead of those elections. We get the results, I'd say, in about an hour and a half. So something very interesting to watch later tonight.
That's true. We didn't even have a chance to get to FX here with this yet another vote there in Britain. So stay tuned for all that as well. Of course, you're going to find what ERIK and Blue and the rest of the team are working on. CMEgroup.com is the place to go. Like I mentioned, they're on the homepage. You just click on over there to the homepage. You'll see all those reports waiting for you. And, of course, our buddy Sean couldn't be here. Head on over to FTSERussell.com. FTSERussell.com is the place to go for all of the research they put out about active versus passive and skew and harvesting, premium harvesting, all that fun stuff. You guys like it. Give him a follow over there on the old Twitters while you're at it, at FTSE Russell. He should be in studio, I believe, next week, so we can catch up with him on all of his global travels and everything else cooking in the land of small cap, which has been doing some interesting things of late. Didn't have a chance to get to those there as well. And on behalf of ERIK and Sean and the rest of our friends out there, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for sending in such great questions. Keep them coming. And we'll see you back here tomorrow for Volatility Views, and then back on Monday for Option Block and all that fun stuff, and then right back through to Thursday for more of This Week in Futures Options.
This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.